Welcome back to another episode of Simplify with Ryan. I'm Ryan, and today we're talking about everyone's favorite season. Yes, it's tax season. I don't know about you, but every year I dread tax season. I have a bunch of complicated tax issues that I deal with from year to year, and unfortunately, although I do learn things every year, it seems like I'm always fighting an uphill battle. Tax code is exceedingly complicated, and every year it gets more and more complicated. So today I'm going to chat a little bit about some of the mistakes that I've made in the past and try to give you some tips on how you can prevent yourself from falling into traps that could cost you a lot of money and be a really bad surprise at the end of every year. If you find any value in today's video, before we go on, I just ask to please like the video, please subscribe to the channel, and if you don't mind, click the little bell notification. That will give you a heads up on any new videos that I create, and it goes a long way to support the channel. So thanks in advance. If you're not interested in that, I totally understand. I'm just happy you're here. Thank you for your support, and I hope you enjoy the rest of the video. Now, when I file my taxes every year, I deal with a couple of complexities. One, I am a W-2 employee, and because of that, my employer does automatic withholding. Now, that withholding is based upon a questionnaire that you fill out, and it can be adjusted to account for some of the other things we'll talk about today as well. Now, on top of that, I also have an LLC, a small business, and I also have real estate. So I file jointly with all of these things, but I have to include a small business income portion, and I have to include real estate income as well. To make that even more complicated, I follow a strategy called house hacking, whereby I live in the property and then rent out parts of the property to other people. Now, this makes things a bit more complex for a number of reasons, and we'll get into that later in the video. So if you're just a W-2 employee and you have withholding every year that's automatically deducted from your paycheck, this video may not be very helpful for you. We're really trying to focus in on some of the more complex situations that you might encounter and give you some tips around how to manage those situations. Sometimes your dog just likes to drink a lot of water right in the middle of your video. Now, the easiest solution to all of this is to hire a tax professional. Although this might not be cheap and you might want to resist the urge to do this, it really makes sense in many cases to have someone who you trust do your taxes every year. Now, there's a flip side to this as well. I've heard a number of horror stories from people who've hired the wrong person, and the person either missed something pretty big on their tax returns or made a mistake that somehow impacted them pretty negatively down the line through an audit. And so I think this is, by and large, an added advantage if you can find the right person who you've built a relationship with and trust. But there are many tools today that help you file on your own and get help if you need it as support in real time. I personally use TurboTax. I do all of my taxes myself. I did have a tax professional prepare my tax returns for, I think, around 7 or 8 years. And once this individual retired, I decided to take on the taxes myself. Now, as you can imagine, the first year or two were very difficult. I struggled immensely to understand all of the different things I was dealing with. Because I had the added self-employment category and real estate, I was very confused. At this point, I now think I have a pretty good understanding of my situation, and even at that, I still make mistakes. I just finished filing my taxes for the 2024 year, and unfortunately, I missed a couple of things and have a pretty decent bill to pay. It's okay, I have strategies around how to prepare for this. I'll share those with you too, but just know that taxes are important, records are even more important, and you can do these things on your own. You can also use a professional. It really comes down to your comfort level. So let's first dive into real estate. A lot of people talk about how real estate provides great tax advantages. Buying real estate will allow you to pay fewer taxes in the long run and ultimately will help build your wealth faster. Now, this concept is true. There's a lot of truth to it, but if you go into it without proper knowledge and preparation, it can also cause you great distress and an enormous bill. And so let's talk about some of these things that you may not be thinking about if you're new to real estate and are just starting out. Now, the first thing, which I think goes without saying, is that on all of the rent you receive, you have to pay taxes. That means that very detailed accounting records are necessary so that at the end of the year, you can tally up this amount and put it into your tax return form. Now this includes some interesting nuances. For instance, usually you have a security deposit for a particular property. Now this security deposit actually counts as income. The second that the tenant moves out during whatever year that is, and you decide to keep a portion of that security deposit to pay for any kind of damage that was done, you have to count that as revenue. This is confusing because, well, let's say the damage was $1,000 out of a $1,500 security deposit. Well, you can keep $1,000, but you're going to pay taxes on that $1,000. So for an example, let's say you're taxed at a 20% rate, $200 of that $1,000 is going to go away to the IRS. This isn't particularly fair, but it's how the system works. So you need to be prepared for that. A lot of people who are new to real estate investing and who have smaller rental portfolios might think that taking cash under the table is a better plan. If you do this, certainly you can hide this and not pay taxes, but in my experience, that's a very bad idea. I actually only accept online payments for my rental units. All of this is tracked through a company. Now, the company at a certain point is legally obligated to report the income that I receive to the IRS. And so all of this is documented in a form. I get that form every year. It tells me how much I made, and I usually compare that to my own personal records. Now, some of this has evolved over the years as the online payment space wasn't always keeping pace with this tax requirement. And so many companies for many years, like PayPal, did not have to report this information to the IRS. And of course they didn't, because that would cost time and effort and resources for them to prepare all of these documents. But due to some recent legislative changes, this is now a requirement, and you will get this form if you're accepting any form of online payment. Now, there are other ways to accept payments. In addition to cash, you can accept checks, and there are probably ways that you can scheme the system, but I highly encourage you to keep very good records and pay taxes on everything that you receive. Now, for me, what I do is I take a certain percentage of all of the rents that I receive each month, and I set them aside. I set them aside into a tax bucket. So this bucket I do not touch throughout the year. Now I have a second bucket that's also there for any kind of emergency that might arise, maintenance of the home. And so I have these two separate buckets, and then anything else outside of that I see as revenue that I can reinvest in properties or the market or whatever other thing I need to be paying for at the time. So be sure to plan ahead. Now, in addition to this, the IRS has a quarterly tax requirement. And so if you have a business or if you have a real estate business, you need to make sure that you're making quarterly payments throughout the year to the IRS. If you just have a W-2 job, automatically from every paycheck, a certain amount of withholding occurs. But if you're an entrepreneur, just a real estate investor, this doesn't happen. And so if you wait until the end of the year and haven't paid any taxes over the quarters that you were required to pay taxes on, then you end up with a penalty. This penalty is usually not catastrophic, but it's enough that you don't want to have to pay it every year. Now, the IRS does offer a quarterly repayment plan. I think you just need to project the amount of revenue that you're expecting, and then you pay on that amount. At the end of the year, if you've overpaid, you'll get a refund. If you've underpaid, you'll have to pay additional taxes. Now, if you're like me and you have a W-2 job and you have real estate or you're self-employed, a business on the side, then this becomes a bit more complex. I can certainly pay through a quarterly plan to the IRS for my real estate, but there's another option. What I do is I increase my withholdings through my W-2 job. This is a simple box. You go into the form and you just change on your W-4 what you want withheld. Now, I increase it by whatever amount I think I'll need to pay. Now, unfortunately, this is where I made a mistake. This year, I didn't increase it by enough, and so subsequently, I now owe a significant chunk of taxes at the end of the year. But as you go through the years, you get better at this. You start to figure out what your sweet spot is, what you're actually making. So let's talk a little bit about how you're actually being tax advantaged through real estate. Well, the big thing here is that you can write off a couple of things which reduce your tax liability. The first is that you can write off any interest that you pay in a mortgage for a property. This is usually not a tremendously large amount, but it certainly can knock off a pretty significant portion of your taxes. Now, if you own a property free and clear, this won't apply to you, but you're probably making up for that savings by not paying interest anyway. Now, the second way that you can get tax advantage is through depreciation. So for a commercial property, I believe you depreciate over the course of 39 years. In the case of residential real estate, so your smaller rentals, anything from 4 rental unit, a quadplex, and down, you will actually have 27 and a half years to depreciate. So basically, you take the purchase price of the home and you divide it by 27 and a half, and each year you're able to depreciate that amount on your taxes. So it can be a pretty significant write-off. You're not paying taxes on that revenue that's in your pocket, and so that's a big win. On top of that, you can write off other expenses. If there are maintenance expenses that occur, utility expenses that occur, all of those things can be written off. You can also write off vehicle mileage if you're supporting a property. So if you're doing a house hack, this gets more complicated. You need to be aware that you can only write off a certain percentage, the percentage of the property that you're renting out. That's the percentage you can write off. And so let's say, for instance, that you have a property tax bill of $5,000 and you rent out roughly half of your home to other people. Well, when you go to write off this amount for your taxes, you can only write off 50% of that tax bill. You can't write off the entire amount. And that's because you live on the property. You wouldn't normally be able to write off your property tax bill if you just owned a home and lived in it yourself. And so a lot of people make this mistake. They write off the entire amount if they're house hacking or renting out rooms to other people, and you just simply can't do that. Now, it's a bit tough to actually figure out the percentage. I just use basic square feet and rental units. It's pretty well documented, and I keep a spreadsheet that has all of these different percentages. And so every year, if I'm ever audited, I can refer to it, explain my logic, and I think it would make the process pretty simple. As long as you have some logic to it and you're keeping really good records, this shouldn't be too challenging. Another thing to keep in mind, if you do rent a property that you also live in, when you go to sell the home, you're not going to be covered by a capital gains exemption. If you do own a home and live in it only, you're offered as a single person a $250,000 capital gains exemption. So you don't pay taxes on anything over the purchase price of the home that you originally paid. You'll get that benefit free and clear. If you're married, I believe the total is $500,000, so you can benefit from a lot of the appreciation that we've seen over the last 4 years. But if you are renting a part of your property, this exemption goes away, and so capital gains taxes will have to be paid on a property that you do sell if you live in it and also benefit from rental income. I don't see this as a very big deal. In the long run, I actually make money back given the rents that I collect. But if you're just in it for a short period of time, this doesn't make a lot of sense. So real estate is really a long-term game. You have to be in it for a long period of time in order to realize the tax advantages and the other gains. Now, when it comes to being self-employed, there are also a lot of similar tips and tricks that you can consider. There are a lot of write-offs. Now, I have a pretty simple business, so I don't have a lot of things to write off. The one thing I do write off is the purchase price of the business. So I didn't start the business on my own. I purchased it, and that expense I was able to amortize over the course of 10 years and depreciate. And so just like you would with a typical purchase of a real estate property, you can write off the purchase of a business over a period of time and reduce your tax implications. Now, this can get really tricky if you're trying to claim office space either in your home or otherwise for a business that you own. The rules are really clear here. You have to measure the exact space. You have to have a pretty good estimate of the amount of time you use that space. And then you put that information into a system and it will tell you what you're eligible to deduct from your tax amount. I actually don't do this, even though I do have a home office. I find that the benefit isn't that great and it's pretty complicated in my situation, so I don't think it's worth the risk. But if in your case you think that this might really help, I encourage you to learn more about it and think about how you might write off some of your space on the business expense books. So I've given you some of my tips and tricks and how I navigate tax season. I think the most important thing here is that you really need to be prepared to pay taxes. I know it's not great to have to pay a large chunk of your income at the end of the year or quarterly as you're making it. I wish there were better ways to navigate this, and certainly there are more complex systems that are designed to trick the system, find all of the loopholes, and pay fewer taxes. The irony is that the more assets you have, the less tax you end up paying. Now, this isn't necessarily a bad thing for society. If you have more assets, you're usually generating more employment and other things for society, and so it probably makes good sense. But what I do know is that the tax code is exceedingly complicated. It's been revised so many different times through so many different administrations, and at the end of the day, it gets to be rather complex to navigate on your own. I think as you scale and get larger, either in real estate or as a business owner, it makes a lot of sense to bring on a professional who you trust to do your taxes. I personally am not big enough. I don't make enough money, and it doesn't make sense for me. I think I have a pretty good understanding of my situation and the intricacies that are involved. And when I make mistakes, I usually correct them pretty quickly and I figure out next year how to do better. But at some point, if I do continue to grow and get bigger in my real estate and other investments, I absolutely will hire a professional. I think one of the biggest considerations with taxes has to do with the emotional impact that it can play in your life. I know every January, February, and March for me can be dominated with stress and anxiety around taxes. Until I get my taxes filed, I feel unease, absolutely. And so if you feel this as well, there are better ways. If this feeling of emotional instability starts to be impactful for you in ways that are harmful, absolutely hire a professional. It takes the burden off of you and really does make things a bit simpler. You also then are assured that you're getting the maximum amount of benefit because you've brought on someone who does this for a living and really follows the changes from year to year. Now, I think it's pretty ridiculous that our tax code is so complicated. One thing I'm really hopeful to see in the future is a simplified tax code that allows things to make a bit more sense. Unfortunately, things aren't like that right now, and so we have to play in the world that we've been given and do the best that we can. Now, my final tip, and I've already talked about this throughout the video, but it's really important to make sure you have enough money at the end of the year to pay your taxes. If you haven't been paying quarterly, or even if you have, you need to have a bit of an excess fund in order to pay any deficit that you have in your tax liability. This will really make you feel much better about going into tax season. You have the money set aside, you're already writing it off of your books, and so if it does come down to the fact that you've overpaid or you only owe a small amount, this is great news. Then you get to keep that money, you get to do something else with it. But you don't want to be in a position where you don't have the money and you can't pay your taxes, and then either you avoid paying your taxes or you avoid filing altogether because you just don't have any other solution. This could potentially haunt you for a very long time. So please try to keep current with your taxes and definitely set aside the revenue right away when you're making money. Take a piece of that and save it for your tax implications down the road. Now, I don't know about you, but I used to think that getting a big refund was a great thing. And so I'll leave you with this thought. If you are getting a large refund at the end of every year, you're actually doing something wrong because you're overpaying the government, your hard-earned dollars, during the course of the year. And because of that, you're giving them a free loan. They aren't paying you interest for that money. They're getting that money at 0% interest and using it for other things. Instead, you could be taking that money and investing it for yourself. If you get $2,000 back, well, that's $2,000 that you could have invested over the course of the year, and that would have grown potentially at a rate of 7 to 10% to be conservative. That's money lost. And so please try to organize your taxes around getting no return every year, and maybe even that you owe some, but definitely don't focus on getting a refund. It's not a gift at the end of the year. It just means you're doing something wrong and you're losing money. Thanks again for joining me for this practical tax video. I know it's not a fun time of year, but we all have to get through this season. So hopefully you found some of these tips to be helpful as you navigate your taxes. If you did enjoy the video, like the video, put some comments down below, and subscribe to the channel. All of that really helps me out. It's free to you, so please, if you don't mind, help me out. If you don't want to do that, not a problem. Thanks for supporting by watching this video, and I'll look forward to seeing you in next week's video. Take care.